Well, hi everyone, my name's Shannon Dakin, and on behalf of the Super Board I'd like to thank you for coming to the first Twilight seminar of the year, entitled The Taxman and a Family Law Matter, a practical review of the tax traps that can and do arise when splitting assets from marriage breakdown. It's my great pleasure to introduce to you tonight Suzanne Delbridge. She's the principal of Delbridge Forensic Accounting in Newcastle, and we're going to have the benefit tonight of over 23 years experience in providing valuations for a range of purposes across litigation and contemplation of litigation also, dispute resolution and for commercial purposes. And also Suzanne's given evidence as an expert witness in the Commonwealth family law jurisdiction and the state courts during that time. So let's get cracking and please make Suzanne very welcome. Do you want to fiddle with that before I start? Or? Sure, I'm just going to do a sound check for the purpose of the webinar, people. I hope that you can hear me okay, and Caroline, I guess you can set it up too if it's not working for you properly. Yes, that's my arm, but that's okay. If the webinar people can't see me, I don't think that's any great loss. You can see the slides and you can hear me, so I think that's the most important thing. Thanks so much for coming along this afternoon to this webinar in person or, or on the webinar, wherever you are. It's great that there's so many people on the webinar particularly and here, which makes me think there's probably 4 reasons for that. Not quite sure when your CLE year ends, but perhaps it's soon and you're desperate for some points. You've got nothing better to do on a Thursday night than come and listen to a talk about tax. You've got no aircon at home and it's so hot up here. I think that would just be a disaster. So it's lovely here at Hotfoot Gannon in their air-conditioned offices. Or you've got a great passion for tax, which is probably not the case. In any event, it's something that's exceptionally important in the work that you do, particularly if you do a lot of property work and if you do work where people have their interest in a corporate or a trust structure or something else, and you need to unravel all of that as a consequence of your family law matter. So this topic has obviously got the potential to be off the charts in terms of excitement. So I'm going to temper that a little bit by talking about tax legislation and the sort of underlying principles behind what can happen when you're carving up assets as a result of a marriage breakdown. But we're going to pull all that together by way of a case study, and those of you who have heard me speak before, hello Mr. Wedgwood, will know that I normally do things by way of case study, and I think that makes the learning easier because you start to get a vision in your head of these people and what their assets are, and you get a picture of what they look like, which, as we all know, can be sometimes really different than the truth. And we'll talk about the tax consequences, and hopefully they'll stick because you'll remember the case study. So in your binder that you have if you're here, or in the notes that were emailed to you if you're on the webinar, the first thing that you'll come across is the slides from the session. Now they're a bit on the small side up there, so maybe if you want to follow along in your little booklet thing, that might help you. Also in there, the next thing, sorry, juggling multiple things here, I've got to get this mouse to work. Okay, also in the booklet is a case study outline, and I'm going to run through that with you, but you don't really need to read it because we'll go through it on the slides. Finally, in your little binder is the paper that I've written, which obviously gives you more information in terms of, you know, I don't quote sections of the tax act and all of that because that's, you know, sometimes you've had a glass of wine, that's just a disaster. But it's there in the paper, and the paper's on our website too if you lose your thing and want to download it later. So in terms of the case study, these are the kind of people that I'm sure you've come across your desk before. John's 45, Mandy's 43. They had an 18-year marriage and they have 2 children who are now 17 and 15. Mandy and John got married in their mid-20s. They've worked very hard. They're good, hard-working people. They've accumulated a nice pool of assets, 5.5 odd million. They've had a good lifestyle as well along the way. So in terms of our pool of 5.5 million, we'll go through that in a little bit of detail. There's a house. The husband's an architect. He has a successful architecture business. There's a boat, a self-managed super fund, and there's some debts. So this is not complicated in terms of big structured trusts and unit trusts and super funds and all sorts of weird stuff. It's pretty basic in terms of structure. There's a company that's got the business in it, there's a self-managed super fund, and there's a house. So these people have reached a settlement. This has gone on for quite a while. They separated in February 2011. So we're now 4 years down the track, through no fault of their own. They haven't settled it yet, but we think they finally might have it over the line. So they have reached agreement as to the settlement. They've got some consent orders drafted, but no one's thought about the tax consequences of what they're about to walk into. And it's essential that we do, because you shouldn't be giving tax advice, obviously, but you should have enough knowledge so that when these issues pop up in your cases, a light goes on and you go, oh, gee, I need to get their accountant to have a look at this particular matter. If their accountant is more of the bookkeeper, garden variety, suburban style, you might need to get some better evidence about what the tax consequences are that might unfold. But if at least the light goes on, then we're heading in the right direction. Sorry, yeah, that's all right. Well, that's a bit tricky. Okay, so in terms of the case study, the former matrimonial home was acquired early 2010 for $1.2 million. Remembering that these people separated in early 11, so it might have been a bit of a last-ditch effort to keep her happy and bought a beautiful home, but it didn't work anyway. When they bought this matrimonial home, it was funded by way of the sale of their previous home, $800 grand, and the other $400,000 came as a loan from Gorgeous Designs. Gorgeous Designs is the husband's architecture business, and we'll talk about that some more in a minute. Shortly after separation, the husband bought an apartment and he's living there with his girlfriend. And Mandy's going to keep the house once they've achieved their property settlement. Can you? That might be helpful. Or just make it go away. Is that me? There we go. Okay, great. So in terms of the company has been the source of the wealth, pretty much. Husband's a successful architect. He does both residential and commercial work. The company was incorporated in the year 2000. John and Mandy hold one ordinary share each in the company. John's the sole director. Mandy was the bookkeeper until about late 2010, and we know they separated in February 11, so she hasn't worked there since. The cars that the parties drive are owned by this company. Mandy drives a nice Audi, John drives a BMW. One of the orders will see Mandy's car come out of the company to her, so she'll keep driving that car. The single expert has valued the company, so the architecture practice and the other things that are in that company, at $3.5 million. That includes the architecture practice and a commercial investment property that they bought through this corporate structure a few years ago that's now worth $1 million. Now, importantly, that property is worth $1 million. They bought it back in 2004 for 300 grand. So it's had great growth. For whatever reason, that property is now worth $1 million, 10 years after they bought it, which is a really solid investment. We're not going to worry about whether that valuation is right or wrong. That's not the subject of today. So you'll recall when they bought the former matrimonial home, they borrowed $400,000 from the company. They've also made significant drawings from the company to fund their lavish lifestyle. They go skiing every year overseas, they go on great domestic holidays, they pay the private school fees, and there's further loans in addition to the $400,000, owing back by the husband and the wife to the company of some $350,000. Now, there was real argument between the parties as to who owed what. They got Vincent's in and they went through and critically examined who owed what. Mandy owes 300 grand of the 350 and John owes 50. In relation to the $400,000 that they borrowed to purchase the home, they entered into a complying loan to make sure they didn't fall foul of Division 7A. And by the time we get to the end of this, you're going to know all about that. That won't be a mystery to you. In terms of the $350,000, which we'll call the lifestyle loan account, there's no agreement in place in relation to that. The Gorgeous Super Fund owns the business premises from which John's practice is conducted. There's cash and shares and other bits and pieces in there. John's benefits 600 grand and Mandy's 200. So in terms of the pool, we've got the former matrimonial home, which is now worth 1.5. And you might be better off looking at this in your slide because it's going to be a little squidgy up on the screen. John's new apartment has no equity in it. Yeah, he owns it, but he borrowed, let's assume he borrowed 100%. There's no equity in that. Gorgeous Designs, we know, single expert says is worth 3.5, inclusive of the $1 million commercial investment property. They owe the money back to the company for the home, $400,000. They owe the money back to the company for the lifestyle drawings, $350,000. John's got a nice boat. Then we've got the super. That rounds out at about $5.5 million. So in terms of what they've agreed, which again, this is not really rocket science, Mandy's going to keep the former matrimonial home. John's going to keep his apartment, but that's, who cares? It's mortgaged to the hilt. There's no value in that. John's going to keep the shares in Gorgeous Designs, and we'll come back to that 2.16 in a second. The commercial investment property that's in Gorgeous Designs is going to be transferred out to Mandy. So Mandy's going to have that commercial investment property. That's worth $1 million. She's going to get to keep her car as well. That's $40,000. John's going to take over the loan that they borrowed, the $400,000, to purchase the former matrimonial home. So he's going to take responsibility for that loan. It's not going to be written off, but he's going to be responsible for that and repay the company eventually. Mandy's debt back to the company, the $300,000, is going to be forgiven. John will owe his $50 back though. He keeps the boat, they keep their own super, and a result of all of that to achieve a 50-50 split sees John giving Mandy $35,000. That's pretty cute, it's pretty neat, achieves a 50-50 split, all sounds good. But what's the tax in all of this? They haven't thought about any of it. Is the pool really $5.5 million? Will Mandy really end up with $2.7 odd million? Well, obviously not, otherwise it wouldn't be good fun in terms of the case study, but let's explore that, shall we? So, getting into, you might want to get another glass of wine because this is the boring bit. Getting into all of this, you will see these structures all the time. People in Australia, if their business is anything other than, you know, the little sole trade of plumber business or electrician or whatever it is, will have their business in a company structure or a trust structure or a partnership. People use these structures for legitimate reasons. Asset protection. If you've got assets in a corporate structure, then perhaps they're protected if something happens to you personally. You might have a risky venture in a corporate structure, again, to limit your liability. You might have your family wealth in a trust to protect it from the spouse who's trying to have a go at the trust structure. The reason I spend half of my life in Melbourne, because it's all complicated, enormous trust structures, and we have the spouses trying to break into that trust structure, and that's just not the plan. There might be commercial reasons why we have assets in one of these structures. It might be workers' comp, you might have subcontractors, and you need to have a corporate structure to get that situation sorted out. There's obviously legislative requirements in terms of superannuation. We have to keep our superannuation savings in a superannuation fund. But obviously the biggest driver for these structures is legitimate tax minimisation. And I don't mean dodgy black money under the carpet, I mean legitimate tax minimisation. A company pays tax at 30 cents. An individual pays tax up with the the debt repair levy thing at the moment, it's as much as 49%. If we have revenue in a trust and it's not all personal exertion revenue, if our business is in a trust that allows us to distribute profit to the family members, once the kids reach 18 and they're at uni and they're not earning anything, fantastic, full marginal rate threshold, away we go. And obviously superannuation, yes, we have to put it in there in the first place, but fantastic in terms of tax concessions and tax concessions on retirement. We want to maximise how much money we have in a super fund. And that's all good while the going is good, but sometimes when we're trying to unravel all of this and get value out to parties, when all the wealth is in a structure, that's when all this becomes problematic. And it may well be that there's actually problems boiling along anyway, but no one but the incumbent accountants looked at it for a long time, and so some of the risks and problems that are in there might not see the light of day, and it certainly might not see the light of day until we're trying to undo the whole thing and achieve a settlement. So I'm not going to dwell on this at all in terms of it's no use looking at all of this and getting excited about it if the court's not going to take it into account anyway. But the cases tell us, and lots of experienced practitioners in here, that we know what Rosati says. If there's a likelihood of realisation, and depending on the circumstances, we might get the tax off in terms of the 79 adjustment, or it might just be a 75/2 factor. But that case is obviously familiar to you. But in terms of that though, in terms of the application of Rosati and whether we're asking the court to make a deduction for some future CGT or some current CGT, we don't have any evidence of it, then what's the court going to do about it? It's not good enough for the parties just to make a submission about that. You probably need at least their accountant, and if not something better, if you're hoping on getting a 75/2 adjustment or an actual adjustment off the pool. Two more recent cases which are pretty exciting, and I'm thanking Mr. Wedgwood up the back there for bringing them to my attention when we wrote our paper for the national conference. Jarrett and the next one, Levine and Connor, are pretty much on the same theme. And what the court's saying there is if there's some uncertainty as to whether a tax liability will crystallise, because you might have a situation where, yes, you've got this pool of assets, you're not entirely sure what might be realised or what might be transferred and therefore what tax might crystallise, it can be appropriate to make a contingent order that might see that tax split in the same proportion as the overall asset split. But again, in terms of the application of both Jarrett and Levine and Connor, if you don't have any evidence about it, then what do you think the court can do about it? Okay, so in terms of what taxes might be incurred, there's four things that are of interest to us. Capital gains tax, probably pretty obvious. Income tax, again, that's received a bit of press lately, and we'll talk about that some more shortly. That's an obvious one. GST doesn't come into it very often because GST is incurred when you provide a taxable supply, and obviously transfers between parties as a consequence of a marriage breakdown aren't in the course or further of an enterprise, so therefore no GST. The exception to that might be if you, for example, got the car in the small business and the small business has been claiming GST on lease payments and things, and the car gets transferred out to the wife. That's a change in creditable purpose of that asset, and the company that's claimed the GST in the past might have a problem in terms of having to remit some GST back that it's previously claimed. So you should be aware of that one. And then stamp duty. Now my slides are actually wrong, webinar people out there who've got them, and I can't change them for you. Stamp duty in your revenue ruling is under review at the moment. So at the moment, stamp duty is obviously an issue up here because if you transfer an asset from a company to a spouse, you'll incur some duty. In other states, that's not in all other states, but in other states, lots of other states, that's not the case. So just sort of be mindful that your playing field may well change there. So capital gains tax is been around for a really long time. It's going to have its 30-year anniversary this year. I'm wondering if we'll have a party about that, like an end of financial year party. We get excited about those sorts of things. So So CGT has been around for a long time, and for most of you in the room, you should be familiar with the basic principles of capital gains tax. If we sell an asset that's subject to the CGT regime for more than what we buy it for, we're going to pay some tax on that. So capital gains tax applies to all assets, with the exception of those that were acquired prior to the introduction of the legislation some close to 30 years ago. And obviously those assets are, I couldn't tell you when I've seen an asset that was a pre-CGT asset, don't seem to be around anymore. Obviously they've been realised and freshened up. Cars and motorbikes don't attract CGT, collectibles and personal use assets, but have a certain dollar value limit there. Assets used to produce exempt income and the main residence, and we'll talk about the main residence shortly because that can be a bit of a bitey one in terms of a family law matter. The other thing to note too is that certain taxpayers won't have CGT to pay when they retire or sell their business because of the small business CGT concessions. And they're important because you might have your client saying, oh, but if I sell this, I'm going to have to pay CGT. Well, not necessarily, because if their worth, and it's a complicated calculation, if their worth is less than $6 million, then maybe these small business CGT concessions can apply to reduce their tax down to nothing. So again, need some advice about that, and that's a whole other subject, so we're not going to go into that one today. So in terms of the concepts though, and in terms of what happens on marriage breakdown, the transfer of assets between spouses or from an entity to a spouse, that's going to constitute a CGT event. So we're in CGT's in play then. We've had a CGT event, an asset has transferred in terms of ownership. We're playing CGT. But if the transfer happens as a consequence of marriage breakdown, then there is a rollover relief. We'll talk about rollover relief in a sec. Rollover relief is compulsory. We don't get to elect to apply this or elect not to apply it. If the transfer happens as a consequence of a court order, binding financial agreement, arbitral award, whatever agreement it is you need to make to resolve a de facto matter, you will have compulsory marriage breakdown rollover relief. If you're wanting not to trigger the rollover relief, then you need to probably do some sort of asset transfer outside of your orders or your binding financial agreement. But then obviously there's lots of risks that come with that, and you need to be very careful about making that sort of move. But it may well be in circumstances where it's a big enough pool and there's a reason that you want to crystallise some tax. It may well be that that's what you do. So in terms of the rollover, we're in the 126s of the Income Tax Assessment Act. A transfer between two spouses will have a rollover. A transfer from a company or a trust to a spouse will have a rollover. A transfer between self-managed super funds will also have a rollover. And what that means is that at the time of the transfer, while there may notionally be a gain or loss that crystallises, that's ignored for now. But what happens is everything to do with how the original owner held that asset in terms of cost base, time of acquisition, holding costs and all the rest of it, that moves over to the new owner, to the spouse. But it isn't a relief. It's a rollover. Let's roll over for now. But when the asset is realised by the person eventually, then the tax will come home to roost. So it's a delay or a deferral. It's not a relief, which I think sort of lulls people into a false sense of security. They don't need to worry about it because there's a rollover. Well, if the circumstances for your spouse that's getting the asset changes, she, let's assume it's she, might have every intention of holding on to that asset for a long time. But a lot of people find themselves in situations where they get a lot of assets, but maybe they're cash poor, asset rich, need to realise something. You might find that someone who thought they were going to hold an asset for a long time and therefore let's not worry about CGT needs to crystallise that asset sooner rather than later, in which case the CGT will be payable. Another important point about the rollover is that the transferee, so the person that gets the asset, has to be a natural person. It doesn't work in reverse. I can't use it as a great tax planning opportunity to put assets into a company or utilise some tax offers or other sorts of tax planning that might be of interest to me. The recipient of the asset has to be a real person. Okay, so you'll recall that one of the main exemptions, or one of the exemptions that I mentioned from CGT is the main residence. So a taxpayer, you know, you've got your house and you're hoping that your house is going to grow in value, and that's fantastic because when you sell your house, you don't pay capital gains tax on it. It's one of the few things that you can have that's a very valuable asset, but when you sell it, there's no CGT. But to get a full exemption, so to avail yourself fully of the main residence exemption, well, you have to be an individual. So if your home is in a trust or some other structure, you don't get the main residence exemption. It has to be your home. You genuinely have to live there, you know, on a very regular basis. It also has to be your main residence for your whole period of ownership. We'll talk about that in a sec. No, we'll actually talk about that now. Disposal results from a number of events, but let's just assume we're selling a house. You can, though, get a partial exemption if it was your main residence, so you genuinely live there on a day-to-day basis, but you might have moved out. You can get a partial exemption then. So if you owned the house for 5 years, you lived in there for 4, when you go to sell it, you'll get the main residence exemption on 4/5 of the gain because it's all based on time in the house. People sometimes get confused with when a property becomes income producing, we get it valued and that becomes our cost base. This isn't that regime. This is in what we'll be doing with it. So how many days did we own it for? How many days was it our main residence for? And it's a pro rata calculation. But the trick with this is that even if it stops being your main residence, you can elect back to say, I'm not living there now, but I still want to treat it as my main residence because it's got this great big capital gain and I want to preserve that capital gain and make sure when I sell it it's tax-free. So if you move out of the home and it becomes income producing, you've got 6 years that you can elect back. So still, I was living over here, but this one's still my main residence and I want to claim my main residence exemption over here. I can't have it in 2 spots at one time, but I'm going to have it over here. Or if we've not used the property for income producing purpose, so we're not renting it out, we can indefinitely elect back that that's our main residence. So that's important here in this case study because you'll recall that John moved out of the main residence 3 years ago and bought another property. So he's got a decision to make. Is he going to elect for that 4-odd-year period post-separation where he's had his unit, is he going to elect for his unit to be his main residence? Or is he going to elect back for the former matrimonial home to be his main residence? And if that's an issue, you need to, so it's only going to be an issue, well, silly. If the party that's moved out of the former matrimonial home has purchased another property, you need to probably flesh out what his intention is. And if it is that you're wanting to get that party to elect back that the former matrimonial home was the main residence for the whole period of ownership, of his ownership, then you should get that election at the time of making, if you're doing consent orders, obviously at the time of doing your consent orders. And a copy of that election is on our website under support documents if you want a very simple thing, if you want to make that happen. Now, I always get asked this question, so I'm assuming someone's going to say, oh, but there's a tricky way out of this because what if the home was joint tenants and not tenants in common? There's no real fixed entitlement there if it's joint tenants. Well, glad you asked. There is a section in the Income Tax Assessment Act, Section 1087, that says if we own an asset as a joint tenant, for capital gains tax purposes, it's treated as if we own it as a tenant in common in equal shares. So joint tenancy, in terms of the ownership of your home, doesn't get you out of this main residence problem that might crystallise when the unsuspecting person sells the house down the track. And we'll look at that in terms of numbers when we look at this situation for Sandy and John. Okay, we're going to leave capital gains tax for a minute and we'll come back to it when we actually go through the implications of these orders that these people are thinking that they're going to make. And we'll spend a few minutes on income tax. So there's a bit of a misconception because we get relief, which we remember doesn't make it go away, because we get the rollover from CGT, it isn't a relief, it's a delay, that we're all good. And that couldn't be further from the truth because we've got the income tax implication. So Division 7A is the deemed dividend section of the Act. And it applies where you've got a company and a company pays an amount to to a shareholder or an associate of the shareholder, and that payment might be cash or it might be a transfer of property. If the company advances a loan to a shareholder or an associate, if the company has previously advanced a loan and then forgives that loan, or if a company meets an obligation pursuant to a guarantee, we may well be in the realms of Division 7A. The implication of Division 7A is that the person who receives the benefit, so the cash, the properties, the loan, the forgiveness of the loan, will be taxed as though they've received a dividend from the company. It's taxed as income to the person that received the benefit, who is obviously probably the non-suspecting, poorly informed person from a financial perspective who's just happy she's got some money, not too worried about where it came from. She'll be the one that has to pay the tax if this comes home to roost. An ex-spouse falls within the definition of associate, so just because they're divorced isn't going to matter. She'll be caught, assuming again it's the wife. We do have an opportunity though to frank the dividend. So Division 7A is an anti-avoidance section, it's a penalty section, where if you just do this in the ordinary course and you get stuck with a Division 7A problem, you'll get an opportunity to fix it, because the tax office always gives you an opportunity to fix it. But if the horse is bolted, you can't frank it. So there's no benefit of the tax the company's paid on this. You're going to pay tax at your full marginal rate on the amount of the dividend. If, however, you do it properly, there is a marriage breakdown concession, Section 109RC. Think rich clients. Rich clients are the ones that have to do this kind of stuff. That's how I remember what that section is. If you are paying a dividend and it's the same rules as capital gains tax, so it's you've got a court order, binding financial agreement, whatever. If your CGT rollover applies, then your 109RC concessions are available and you can frank it. A fully franked dividend, not this year, but because of the debt repair levy thing, but you pay extra tax of about 23.5 cents. If you get a fully franked dividend, the company's paid 30 cents. If you're on the highest marginal rate, you pay an extra 23.5 cents on top of what the company's already paid. So if I get a $100,000 deemed dividend that's franked, I pay an extra $23,500 tax on it. So there's certain exclusions though from Division 7A. Loans made from one company to another. Because we're still in the corporate environment, we're still on the 30-cent tax bracket, there's no leakage of value out to anyone other than a company. So a loan from one company or a payment from one company to another is okay. Loans made on commercial terms we'll talk about in some detail, and then payment of a genuine debt, which is the one that received all the press halfway through last year in terms of big horrible change that the tax office made. Just briefly, and how long have I got? Okay, all right, cool. Well, battle on then. In terms of the loans made from one private company to another, just an interesting case study, which is not this case study, but a real life one that I'm working on at the moment. We're playing with a pool of about $220 million. The money, interestingly, the money is largely inherited money with Grandpa having owned a coal mine, and the value has stayed in the family. Despite that monumental contribution, we've achieved a 50-50 split, which is pretty special. So the issue, though, is that all of this wealth is in a company, and we need to get $93 million out to the wife to achieve the 50-50 split. And the wife doesn't want to stay as a shareholder in the company because it's all yucky in terms of other issues going on. We need a clean break. We really need to get her out. So dribbling it out is not an option. But because we can make a payment from one company to another company, what we've done, and again, we're in a situation where there's enough money to play with here. The wife was a shareholder in this company. She's transferred her share to another company. So there's another rollover where we're rolling over her share in this company to wife's new company. And what we're going to do is, that's happened, is pay a $93 million dividend from old company to wife's new company. And we're not falling foul of Division 7A. Now our private ruling is due out next week. We understand from the tax office that they're happy in terms of Part 4A, there's no anti-avoidance issue. The rollover of that share that the wife held in old company to her new company is all good. They're happy with that. And the dividend, there's going to be no implication. The downside is there's going to be $93 million that's stuck in a company structure still. But seriously, she can dribble money out and incur some top-up tax as and when she needs to access that money personally. But again, from her, she's a gorgeous lady in her early 50s. She's probably good at in that corporate structure from an asset protection point of view with a really clear path as to where her wealth has come from. So I'll be really interesting. It's the 12th of March next week. Yeah, that's when we're expecting the results from the tax office. So fingers crossed to get the thumbs up. In terms of the loan on commercial terms, this one actually comes up in lots of cases. People will borrow money. So we know in our example that John and Mandy borrowed $400,000 from the company. They entered into a complying loan agreement with the company to ensure they didn't fall foul of Division 7A when they took that $400,000 out to buy the form matrimonial home. For a loan to be a complying loan, though, it needs to be made on commercial terms. There needs to be a written agreement. If you see asset loans in a company balance sheet that are owed by the parties and they say, yeah, that's a Division 7A loan, but it's all good and my accountant's got that all sorted, and you ask for a copy of the loan agreement and they're unable to produce it, it's not a complying loan. You don't get past point 1. If they can't produce the written agreement, you've probably got a problem anyway. Before you even worry about forgiving it or before you even worry about the security position going away, you've probably got a problem. So written agreement. If the loan is unsecured, the maximum term is 7 years. If it's secured and the real estate has to be 110% of the value of the loan, then you've got 25 years to pay it off. So it sort of is like a mortgage from yourself if that's your company. There must be interest charged at a benchmark rate, which the tax office sets, and there must be minimum repayments made. Now, if you've got a company and there's no interest income in the company, then again, they're probably not paying interest. They've probably got a loan agreement, but they're not complying with it, in which case it might not be a complying loan. So a bit of scrutiny is required there. One of the tricks in this, though, is what happens when the security position, it might be a 25-year loan. So let's assume John and Mandy borrowed $400,000 from the company when they bought from matrimonial home, entered into a 25-year complying loan agreement, secured over the from matrimonial home. Fantastic. Mandy's going to take the home, John's going to take the loan. So the security, where's the security coming from now? She says, you can't use my house to secure your loan you owe back to the company, so you can't continue to rely on that agreement that was made when the loan was first advanced. You either need to find some new security, which she didn't have, or it becomes a 7-year loan. And from a cash flow perspective, in terms of his ability to pay that, you might want to know about that before he goes and agrees to give everything else. Okay, payment of a genuine debt is the one that copped all the press. So this is the one that says if there's a genuine obligation on the company to pay an amount, then the payment of that amount won't fall foul of Division 7A. So, sure. I think it'd be okay because it's still company to company. Depends when the individual gets involved. Cash. So it's a payment of a genuine obligation. Yeah, it's probably okay. Okay, so in terms of 109J and its interplay in a family law matter, what would happen in bigger cases where it was warranted was that the company would be joined to the proceedings. There would be an order made that the company pays the spouse X amount of money. That's a genuine obligation that the company pays the money. Therefore, we're putting our hand up and saying that's 109J. It's the payment of a genuine obligation of the company to pay the shareholder an amount of money. We don't have a Division 7A problem. It's not taxable in the recipient's hands. And you would be able to get a binding private ruling from the tax office to that effect. But that all changed, and it really all changed, even though the tax ruling came out in July of last year. it really all changed from November 2013 when they issued the draft ruling, because from the draft ruling point of view, they weren't signing any more private rulings. So really the game was all over at that point. You know, you had the old Financial Review up in arms about the whole thing, and, you know, tax office, you know, ruins family law matters and spouses will get half. Really? That was all a bit of nonsense, I think. To mine, it was always too good to be true. If you've accumulated all your wealth in a corporate structure, you've never paid proper dividends, you've had the benefit of your 30% tax rate, at some point in time this has got to come home to roost. And to think you can get multi-millions, as what would happen, out of companies for spouses with no tax implication, really, as me, the taxpayer, you know, that has to go to the public hospital, I'd really rather someone pay some tax, because I think it was, it really was avoidance and a loophole that's now been shut. And I don't think it happened all that often, other than at the serious big end town where you're playing with that much money. Division 7A won't only apply when you've got a company. If you've got loans owing back to trusts and a company involved with unpaid present entitlements and things, you might still be stuck. So I guess my take home in terms of that is, if you've got a structure that's got, you know, a company, couple of trusts in it, just because the parties don't owe money back to the company, don't assume that you haven't got a Division 7A problem happening in there somewhere. Get someone to have a look at that for you. Okay, so GS2 we've already talked about. Stamp duty is, for you guys, under review in that little purple book. If you're doing matters where there's assets in other states, there's a table at the back of the tax consequences tab in there that sets out on a state-by-state basis what is exempt and what's not across the country. Yep. Yep. So if you've got a situation where you've got a family trust and the family trust has been making distributions to a bucket company, but not actually paying the money over. So we're availing ourselves of the 30% corporate bucket company tax rate. So trust owes money to bucket company. Bucket company is owned by mum and dad. Mum and dad are also in this trust, trustees, appointor, whatever. We know we can't draw money out of the company or we'll fall foul of that Division 7A. So we draw all our money out of the trust. So we owe the trust money, the trust owes the company money. We're falling foul of Division 7A because the tax office collapses all that in on itself and says, really, what you've done with the company money, pay it yourself via this company that you've never paid the money to, therefore you're going to fall foul of Division 7A anyway. So that's the interplay. And I'm sure there's lots more complicated, convoluted ways and things that happen there, but that's a basic way of explaining that. Okay. So in terms of, back to our case study, that's a boring bit. You're all awake. Does anyone need a drink or a glass of wine or something? We'll bring it all home from here. Back to our case study and the specific examples that we've got here. Order 1 sees John's half of the full matrimonial home transferred over to Mandy. So in terms of what happens now for John, nothing happens. He's just not going to own half of that house anymore. Compulsory CGT rollover relief. No stamp duty implication for Mandy because it's spouse-to-spouse transfer of asset. We do have an exemption. Happy days. The issue with this is going to be what happens when Mandy sells the house. Because John's not been living in that house, we remember, from February 11 till, and this example assumes that the orders are made in December 2014. They've got, whatever that is, close to a 4-year period where he's not living in the home. What's he going to do with it? Oh, you can have 2 separate elections, but it's going to affect what happens to the recipient of that asset when they sell it. Yep, yep. So we'll go through that right now. So in terms of the main residence election, when Mandy goes to sell the house, for the half of the house that she's always owned, that's okay. She She's owned it from when they bought it in January 2010 or whatever it is to when she sells it. She's always owned that half of the house. So that half of the house, all good, quarantine, main residence exemption, don't need to think about it again. What we're interested in here is what's happening with John's half of the house. So let's assume, and this is going to be, it kind of needs to be explored, because if John bought his unit, but like all, units off the plan and they hit the market and it's worth less than what he paid for it, he's not sitting on a great capital gain in terms of his unit, but her home that they've owned the home they've owned for a longer period may well have experienced some growth. You really need to sort of get an understanding of when did they buy these things, what they pay for them, what they worth now, and you're going to know all of that in the course of doing your family law matter anyway. Let's assume, though, that John's apartment was a good buy and he's been living there for 4 years now, this has gone on for ages, it's grown too, and he doesn't want to elect back that the main residence has always been his home. He says, no. Well, yeah, and that's the difficulty. Yep, yep. And so the difficulty, and that's why I suggest to you that if you're wanting to get the election, get it at the same time as you're signing your orders, because once he's off in the ether and, doesn't want to know about her, you might not get that election that you might have been able to negotiate at the time of signing your orders. I wouldn't leave it into the ether, but I don't know the answer to that. Okay, so let's assume his unit is a good buy and he wants to elect that to be his main residence. When she goes to sell the house, there's going to be a portion there that the main residence exemption is not available to her because John wasn't living in the property. So let's assume that, so we make the orders in December. You might recall, I think they bought the house for 1.2. At the time of making the orders, it was worth 1.5. She hangs on to it for a bit longer, it's worth 1.7. She's a beauty. We're making a good gain here. I'm going to get to pocket all this money. So if we look at this calculation, and I suggest you have a look at it, what's in front of you, not on the screen. So we're only looking at John's half. So half of 1.7 is $850,000. The cost base of the property to John. So when John bought this property with her back in 2010 for 1.2, the cost base rolls over to her because of the marriage breakdown rollover. So John's half of the property has a cost base of $600,000, being the original cost base. It's not half of 1.5 that we had it on our settlement balance sheet for. It's the half of the 1.2. So there's notionally a gain here of $250,000. We'll get some main residence exemption though because she owned it. He lived there for a bit. So he lived there for a bit. Then he didn't live there, and now she's living there. So once she gets the property, it again becomes pure in terms of main residence exemption because she's living in that half of the house and it's her main residence. So we're only looking at that bit of ownership that he wasn't there. So from January 2010 to when she sells it in June 15, so the whole period of ownership, 2006 days. He doesn't want to elect that it's his main residence. So he's not there from February 11 until the period when he transfers it to her. Because after that, it doesn't matter, it's all good, it's her main residence. 1,429 days. So we're only getting a partial exemption here. 71% of his half of the house, the gain on it, is taxable. So a capital gain of $177,000. She will get the, I've owned it for longer than 12 months, so I get the 50% general discount. And again, she hasn't only owned it since December. His date of acquisition has rolled to her, fortunately. So she's owned that half since January 2010. She gets the discount, but she's got tax to pay, assuming she's on the highest marginal rate, for $43,500. Now, in the scheme of things, so when they bought the house to when she sells it. She's selling the house in June 2015. Yep. When he moved out. When he bought the unit. Yep. He still owned it. He's living in his unit. That's okay, because it's his main residence when they're living together. payable. Yep, because that's the period that he's not there. So 1,429 on 2,000 odd days is 71% of the time that it was owned. He wasn't able to claim the main residence exemption. So from when he moved out to when he transfers it to her pursuant to the orders is 1,400 days. Yep. Okay. So $43,000, not sheep stations, but remembering she's only getting $35,000 from him pursuant to the orders. I mean, she's going to get some rent on the commercial investment property, but where's the money coming from? She's a bit dirty at that point, but when she sells the house that she thought was her main residence and would never see the light of day in terms of tax, she's got some tax to pay. She needs to know, and she needs to, subject to the growth on his unit, maybe compel him to sign an exemption back that it's going to be a main residence. Exactly. So he's going to have a decision to make. Yep. Okay. In terms of the transfer of, she owns one share in Gorgeous Designs, the architect's company. She's going to transfer that to him. That's all fine. So it's again spouse-to-spouse transfer. The share will roll over to him, so he will continue to own that share in the same manner as which she did. Again, spouse-to-spouse transfer, so exempt from stamp duty. No implication there. You just need to be careful. If there's a greater than 50% change in ownership of a company, then you start to potentially upset your ability to claim tax losses and upset cost bases and things, but I'm not going to overcomplicate that by this, but just be aware if you're transferring more than 50%, you might need to again explore the implications a little further. Okay, order 3 in terms of the super fund. Remember, she's got a benefit of about $200,000. Thankfully here there's enough cash in the super fund and we can get her out. Or it might be cash or listed shares, whatever. They're just going to be distributed, either paid or distributed in specie over to her new complying self-managed super fund. There'll be a rollover there, no drama. Just be careful though, because if you've got assets in a self-managed super fund environment that you need to liquidate before you can cash her out, there is no exemption on that transaction within the super fund. So if the super fund sells something, it will pay tax, and then it's only going to have the net left to be able to transfer over to her fund. If you transfer the asset in specie or pay cash that was already sitting there, you'll be okay. Okay, orders 4 and 5 are starting to get a little bit more interesting. Order 4 though is okay. So you'll recall that the parties borrowed $400,000, had the complying loan agreement back to the company when they bought the home. John's going to take over that loan though. So we're not writing it off. He says, I'll be responsible for that. I'll pay the company back. But again, the trick there is making sure that a new complying loan agreement is entered into, because your security has gone, the home is gone, and you need to look at what he can secure it over, or the terms that might need to be in that loan agreement to ensure that that loan still complies with Division 7A. The lifestyle loan, though, is a bit trickier because of the $350,000 that they've drawn out. I mean, for starters, if there's no complying loan agreement, they probably already have a Division 7A problem. This is probably sitting in there. It needs to get fixed because either they needed a complying loan agreement in the first place, or it's already an undeclared deemed dividend. So there's a problem with all this anyway. But we know that, I think I said, Vincent did the report, she owes $300 grand of it, we're forgiving it. That's an enormous problem because a debt forgiveness falls foul of Division 7A, that's going to be taxable in her hand. If we don't wise up to this and avail ourselves of the 109RC concessions, not franked, taxable, let's assume she's on the highest marginal rate, she's got tax of $147,000 to pay. Now she's not, don't be confused and think she's getting 300 grand and she's paying 147, that's okay. This 300 grand went. It's gone on Prada shoes and Louis Vuitton handbags and ski trips and stuff. It's not there. So she's spent that. All she's getting is a $147,000 tax liability. She's not got the cash to pay for it. How's she going to pay for this? And again, remembering that she's only got $35,000 from the husband, she's going to have to start thinking about selling some assets, I think, because her tax situation is such a shocker here that she needs to know there's a big problem with that. If they frank it, it's better, still not fantastic, still $81,000 worth of tax. That's if they do it properly and frank it and use the 109RC concession. And it just alarms me the amount of times. I mean, it's interesting, and I don't know what the valuers up here do. When we do a business valuation, if there's a corporate structure, trust or whatever, we leave all the loans in the balance sheet, in our valuation, and then we do a summary table that says, this is the value of the company, but included in that value is an amount owing by the parties. We show that liability so that it's really clear where those loans are. If you just forget about them all, and I know there's lots of valuation reports that I see where the valuer just says, oh, that's all just between the parties, it doesn't matter for this purpose, let's just ignore it all, then that's a bit of a problem in terms of Division 7A and runs the risk of, I was giving evidence in a trial in Perth late last year, and the related party loans weren't even an issue. I can't remember what the business was, but I finished giving my evidence. I was sitting in the back of the court, and the parties were then talking about the agreed balance sheet, and then what's happening with these loans. And Her Honour said, oh, we're just all in the back of the court. Can you come and tell us? Should we just forget about all this? And I'm going, no, don't do that. You know, you need to transfer the wife's loan to the husband. You can't just forgive her loan, or you're crystallising a Division 7A problem. So thank heavens I was there, and she invited me to come back and inform her about what the consequence would be if we just forgot about all these loans. So just be careful. $399 or pre-2007. Yep. Yes. Yes. Yeah, so because you'll see on a balance sheet, it will say the pre-2007 UPE or something or other. That's quarantined from this, but if you do freshen it up by some sort of transfer or some sort of situation, then you're back, Division 7A is back in play. Yep. Well, just sort of going to sit there on the never never. But it may well be that you've got, in a case that we just finished, there was $2.7 million owed by a trust to a corporate beneficiary, but no one had done accounts for that corporate beneficiary since Adam was a boy. And we were sort of, well, do we just ignore it when we're doing the trust and then ignore the company? And we went, no, we can't, because by ignoring it, by writing it off, that becomes a forgiveness, and it upsets the protection that it had by being a pre-2007 loan. Exactly. Yep. Okay. Sorry, are we finished with that? Yep, we're finished with that. All right. It just keeps getting better for Mandy. The commercial property, the $1 million property, the fantastic investment that we bought for $300,000 back in 2004, Mandy's going to get that property. Monumental debacle about to unfold for Mandy. You'll recall that Division 7A applies where we pay an amount or transfer property to a shareholder or a shareholder's associate. Mandy's getting from the company a property worth $1 million and she's paying no consideration for it. We've walked straight into a great big Division 7A problem. That will be taxable in her hand. She's got the property, she's got the benefit of this transfer. If this isn't franked, $490,000 worth of tax would be paid this year when we've got the debt repair levy. If it's franked, $271,000. Now my slide is wrong because it says there's no stamp duty consequence. In Queensland at the moment there is a stamp duty consequence because we're transferring an asset from a company to a spouse. So my quick Queensland calculated thing says it's about $38,000. I don't know if that's right or wrong, but that's about the amount. Okay, righto. For the purpose of the example, let's assume we've got some stamp duty paid. So that's pretty horrible, isn't it? Mandy's got a house and she's got a commercial investment property, and she's now got tax all over the place in terms of things that she has to pay in terms of these dividends that she's got. But the problem doesn't end there. If Mandy decides, oh yeah, God, I've ended up with all these assets, but I've got all this tax to pay, I'm going to have to sell that property because I can't afford to pay my tax. I mean, she could borrow against it, sure, but I don't know what she's earning. But in any event, let's assume she decides to sell the property. Despite the fact that Mandy has received that property and she's had $1 million Division 7A problem, her cost base of that property isn't $1 million. It rolled over from the company. The matrimonial rollover relief, 126.15 of the Income Tax Assessment Act applies. She gets that property on the same basis as which it was owned by the company, $300,000 cost base. So when she sells it for $1 million, even if she sells it just for $1 million, so she sells it for what she got it for, she's paid that whopping great big amount of Division 7A income tax. She also now has to pay capital gains tax because she sells it for $1 million. The cost base to her is $300,000. She's got $171,500 worth of tax to pay on the sale of that property. So of the $1 million that she thought she was getting, she ends up with about 300 grand, which is just a dead set shocker, I would have thought. So she's got $1 million worth of property. If it's unfranked, 490 grand on the deemed dividend, 171,000 on the sale, $38,000 worth of stamp duty. She ends up with $300,000. So is our 50-50 split still a 50-50 split? Probably not. Now you might be thinking, oh God, if I was advising Mandy, shivers, I need to be dusting out my PI policy here because this one might come and bite me. What if you're advising John? And you say to John, well, she's seeking an indemnity from all the taxes. Should we give it to her? Oh yeah, it's all good. Nothing in here that's going to be a problem. And John gives an indemnity. John's lawyer is equally dusting off his PI policy because there's all sorts of latent issues here that he might have to pay for. So in terms of poor Mandy, I'm not going to spend much time on this case, but if you've got a case where you think, gee, something bad happened and it's hard luck and we can probably go and have another crack at it, have a read of Greenwood. You need to have something better than, oh gee, with poor Mandy, she got done, before the court might entertain whether or not you can have another crack at the title if you're not happy with the ultimate outcome. In terms of, we're on the home straight now, guys, too, which I'm sure you're all really pleased about. The car, how often, and I bet you've all had cars that spouses drive in a company and the wife keeps the car. Then dividend problem, guys. If the wife doesn't pay consideration for the car, just like the commercial investment property, you're giving her the car, she hasn't paid consideration for it, she's received a benefit, that's a dividend in her hand. So again, poor Mandy, she's got another $20,000 worth of tax to pay here. In that situation with something so small, I mean, I think the appropriate action would be to get the person that's keeping the company to just, presumably they've got a loan account, add it to their loan account. So again, there's a complying loan agreement in place. That person takes responsibility for that payment. She drives away with the car. If not, leave the car behind, go buy her a new car. And that one, like I said, there might be a little GST problem there. So we get some accounting advice about that. So in terms of the final bits and pieces, John owns his boat, he's keeping his boat, happy days. John's going to sail away on his boat. He keeps his shares in the company, that's fine. Again, just be careful about whether there's that greater than 50% change and whether some other sort of issues might happen in terms of his tax losses and things that he might have. And he keeps his new apartment. So there's no immediate implication for any of that, keeping his boat, keeping his shares, keeping his apartment. His franking account balance, though, in gorgeous designs, would have taken a big hit because of all of this. Because what happens, the other double whammy in terms of Division 7A is the taxpayer gets, if it's not done properly, the taxpayer will be assessed on the dividend without the benefit of franking, so pay full-on whole amount of tax, but the franking account balance gets reduced as though it was franked. So, yucky, really. So, did we achieve the 50-50 split? Well, If it is that all of this was unfranked, in terms of what's left after some $870,000 has gone off to the tax office, and Mandy's borne the brunt of all of this, yes, the pool wasn't ever 5.5, it was 4.6, but Mandy's only getting 40-odd% of it. She's not getting 50% of it at all, but she's borne the brunt of that whole reduction in value. And that is only 34% of the original pool, which probably was a bit of a pipe dream anyway, because of all the tax that was really sitting in there the whole time. She's not happy, Jan, and she's looking for some vengeance. If we have a look at the franked situation, so yep, we were kind of half clued up about this, and we franked these distributions out to her. Again, of the materially reduced pool, we weren't playing with 5.5, we're playing with 4.9. She's getting 44% of the pool, not 50% of the pool. So I guess the moral of the story is that you really need to be aware of the potential of tax crystallising when you're transferring assets around, particularly when you've got a corporate structure. That 109J exemption isn't available, but you know, I think that's all a bit of a storm in a teacup. Sure, it was great in great big property cases, and it's a bit of a bummer it's not there, but we just need to be a bit more creative about how we settle things. But the court can't take any of this into account unless you've got some good advice about it, some good evidence. So the party's accountant might be a good one that's in a position to be able to do that for you. You might be able to get your single expert to do it for you, or it might be super tricky and you need a tax specialist to do it for you as opposed to the normal forensic accountant that you use. I have. Yes. Yep. I mean, to be honest, if he was just renting, I mean, if he was just renting, it's okay. You still might, to be sure, want to get that election. I mean, but yeah, it should only apply if he bought another property that he may choose to claim a main residence exemption on, because otherwise there's no risk. Yep. Yeah, it will. The recipient of the dividend pays tax on it, and the company loses the benefit of the franking credits to whatever it would have been had it been franked. Correct. Good. Caroline did a great job.